I'm not bullish on any of them because you need like a very specific set of circumstances to be true for liquid staking to repeat the kind of success story that it has on Ethereum. The first thing to understand about ETFs in general is like they will basically all compete on price. That's why staking ETFs are going to have a big advantage over non-staking ETFs just because they can pay you right from the rewards, like your balance is still going to grow. It is actually a very good and like attractive product. If I'm talking about restaking and talking about institutional, demand, like the problem here was like in both cases that the staking setup that Lido gave you was not flexible enough, right? It was opinionated. It was not putting your money in restaking. You were getting the same returns as everybody else. We're not able to choose who your node operator is and like what MEV relays they use and if they use DVT or not. And so I think the idea of vaults is a very kind of organic one. Create your own staking setup with your own node operators and then have the ability to mint the liquid staking token, like in our case, stake ETH, against that with a collateral ratio that is based on that vault's risk profile.
Hello and welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Brian Crane, and today I'm speaking with Hasu, who is a crypto researcher and writer and strategic advisor to Lido. Of course, Lido doesn't need much of an introduction, although we will introduce it, but Lido is the leading liquid staking protocol and one of the leading staking projects. So really exciting to talk about Lido and some of the evolutions that Lido's gone through and that are upcoming for Lido. So really excited for that. Now, just before we go and talk with Hasu, we'd like to share a few words from our sponsors this week.
If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital, and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on EigenLayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at chorus.one and start staking today.
This episode is proudly brought to you by Gnosis, a collective dedicated to advancing a decentralized future. Gnosis leads innovation with Circles, Gnosis Pay, and Metri, reshaping open banking and money. With Hashi and Gnosis VPN, they're building a more resilient, privacy-focused internet. If you're looking for an L1 to launch your project, Gnosis Chain offers the same development environment as Ethereum with lower transaction fees. It's supported by over 200,000 validators, making Gnosis Chain a reliable and credibly neutral foundation for your applications. Gnosis DAO drives Gnosis governance, where every voice matters. Join the Gnosis community in the Gnosis DAO forum today. Deploy on the EVM-compatible Gnosis Chain or secure the network with just one GNO and affordable hardware. Start your decentralization journey today at gnosis.io.
Cool. Hasu, actually, you've been on before. It's been 4 years, almost 4.5 years, so a long time ago. It's good to have you back on.
Yeah, the episode was a long time ago, I think, with Kane from Synthetics or something like that, if I remember correctly.
That's
yeah,
right.
It's good to be back. Thanks,
Yeah,
Brian.
about liquidity mining.
Yeah, when like all of that started, right? It's crazy that like liquidity mining was this topic that like there was a time when liquidity mining was like so new that we had to discuss it on a podcast, right? That's what it meant.
Yeah, it was the stone ages of DeFi back then when you were still using a manual, I don't know, living in a cave, but starting to DeFi.
Right.
So how did you first get involved in crypto? What's your crypto journey?
Yeah, I think the kind of short version is I was a professional poker player for 10 years. During that time, what started as a hobby and like, an activity where if you were motivated and you were somewhat intelligent, you could make a decent living. Like it became much more a sport over time, or I would say like kind of became professionalized in many ways. And if you wanted to to be a top player, you had to work with, what's now known as solvers, like kind of type of like chess computers, but for poker. You had to, build software. You had to study a lot using the software, try to improve your game. And over time, I became more and more.
You play poker, but then you'd have software to help you decide what hands to play.
So no, so you weren't allowed to use any of the software in real time. The same way if you go to like chess.com, you're not allowed to use a chess computer on the site. That would be considered cheating, right?
But with poker, how do you check that? Is it sort of honors based or?
So at the time, basically, the kind of poker solvers weren't really commonplace yet, I would say. And the ones that were out there were like pretty crude. So it was actually not easy technically, I think, to even try to get that to work, to use it in real time. Today, it's a different story, right? Like today, you can get those things for like very cheap. They're very fast. And so, yeah, like today, actually, pretty much anybody could cheat probably in online poker if they wanted. And that's why is a big reason why the game is kind of dying. And the main games or like the biggest games now are played exclusively between people who know each other, and it's like reputation based. And in a lot of cases also people just play offline where maybe you don't have the same challenges, right?
That's interesting, right? That's kind of like maybe general. It's interesting to think about that because with AI, I guess that's going to happen for like all kinds of stuff, right? Where you so far had like humans compete, and then you're like, this is not really working anymore.
Yeah, I mean, did you see this? I don't know, the other month there was a scandal about somebody had like invented a systematic way to basically cheat in job interviews online using AI.
So of course, one, we have this issue like all the time, right? So we have it all. First of all, we ask like questions when people apply, sort of like essay written questions, and then I think our team is like, this is an AI generated answer, but of course, I don't know what's the detection rate is here. But then I think we've also had various cases where, our team like suspected or where clearly people are using, live in real time as they're getting asked questions using like ChatGPT to get answers. But then I think in some cases they're like, okay, that's definitely happening. But then in other cases, they're like not sure. And it's very tricky.
Yeah, so I mean, chess had this problem before poker because chess computers existed, probably a decade or two before poker, like poker solvers did. And they have killed like poker, like chess that's played for money, like to a big degree. Like that used to be played for money, same as backgammon, and those games got basically solved, and like cheating became too easy, and so the trust problem was basically insurmountable. But there are also forms of chess. It's called centaur chess. Centaur because it's like the centaur is like half horse, half human, right? And like a centaur chess is basically like half human, half AI. And so it's the idea that you can have AIs compete with each other, you can have humans compete with each other, but if you throw like a human and an AI together, it's still a challenge, right? Like to beat another human and another AI in combination. And so it's the idea in a lot of ways that yes, like AIs will play a much bigger role, but like an AI that's somehow bundled with a human or controlled by a human will always be more effective than just a human or just an AI.
And so that's the case for chess, that like human plus AI beats AI?
Yes, it actually did. Yeah. Like, because I mean, there are many cases where I don't know how it works now, right? Like, but in poker, there were many situations where the AI was actually completely indifferent between choosing like one of two or one of three options in a given situation. And whenever something is close, I think human intuition can play a pretty big role. Also, AI, like depending on how good the abstraction was that basically the game was solved on, because poker is too big to solve like the full game, quote unquote. Like you have to make a simpler game that is kind of an abstraction of the bigger game, then you can solve that. But then you have this abstraction step also back, right? So because they the solution you see like, oh, I'm supposed to play this situation in this way. But like if you're an expert in solvers, then you know that the AI probably never got to look at this exact situation. This is only part of like a bucket of like 1 million similar situations that it's all grouping together. And so, if you know these things, then you can add a lot of kind of intuition and like nuance on top of maybe what the AI is already
Yeah.
suggesting.
I mean, that is, I guess, the great hope we all have, no, is that like somehow, we'll be able to like leverage or merge and cooperate with AI in ways that, we can amplify what humans can do, and you're not just become made redundant by the computers.
Yeah, I think so, right? And this goes back to what we were talking about in job interviews and so on. I like, to the degree that we're still trying to test human capability. I mean, we now need to test like human plus AI capability, right? It's how good are you in working with AI? And I mean, the most obvious thing is like the things we test for can become much more complex, right? Like much bigger in scope, right? Where previously you would send someone like 5 questions to answer, maybe you now give them a much more expansive work test that fully acknowledges that.
That is a great point, right? Maybe one way to go would be, or maybe that is the inevitable thing to go, is that you say like, hey, we're going to do this interview and you explicitly are allowed to use AI. And then we're going to see, but I don't know. It's a tricky one too. I guess you'll have to totally redefine how the interviews work.
Yeah. And I mean, you can even include, let me watch you use AI, or like document, give me your prompt history, right? Because even the way that like somebody talks, I'm like, okay, so I like a lot of people I know are saying, I mean, I'm not a manager, I'm more of an IC, but I used to be a manager in the past, and I think the way that you manage people, especially more junior people, is very similar to basically how you would prompt an AI. Like I see a lot of parallels, and I think a lot of my friends who are managers are saying the exact same thing. They really see very little difference between like how you correctly prompt an AI and how you delegate a task, for example, right? And that is a thing that first of all, like humans are going to get much better at delegation, I think, and management as a result of having AI, because all of us have like 1,000 junior employees if we want, like from now on. And you can test those things, right? Like in the past, it used to be actually pretty hard to test someone's management skills in an interview setting, but now you can have a real kind of simulated management relationship, even just by looking at someone's prompt history, which is very interesting.
Yeah. Okay. Very interesting. But let's come back to the topic, to the crypto question. So you were playing poker, and then
Yeah, so I was playing poker, but I realized over time I became, fell more in love with the studying aspect of the game, this way of like working with solvers, but like mostly like thinking about the game and talking about the game with other people, and kind of like unraveling, its mysteries, and finding new ways to think about it. Uh, and I was always part of a group with other people, and we were kind of coaching each other. And I was coaching some people, and I realized that this coaching, this like studying and coaching aspect, like I was much more motivated by learning and teaching other people than I was at some point by competing. Um, and I knew that when I am done with poker, I want to do that full time. I didn't know what topic, but I knew basically the form factor that activity would have to take. And when I later found crypto, I like crypto was always kind of maybe a little just like right outside my my orbit, basically. So that I knew a bunch of my friends were already like buying crypto since 2013, 2014, making money and dabbling with like trading, and also we were using it to send funds back and forth occasionally. When I then started to actually look into it, I very quickly fell down the rabbit hole and that decided that, this would be the thing that I want to spend probably the next at least decade of my life on. And, I already knew what form factor I wanted that activity to have. And so for the first couple of years, I only basically focused on studying crypto from many different angles, and write about it, tweet about it, make a podcast about it. And luckily, it turned out that crypto is actually uniquely well suited to such an approach, just because it's so complex and so interdisciplinary. You really need to kind of understand a lot of different aspects, ranging from economics, politics, law, computer science, game theory. Like you can look at this from so many different angles and always find like new, interesting ways. And a lot of good insights come from putting those different perspectives together. Yet crypto was still so new as an industry that somebody could come in from like totally kind of the outside and just by being a generalist, catch up to whatever is the frontier of that industry within maybe 2 years, and then start making net new contributions to the industry, right? And I think when you come into, I don't know, like math or physics or really many, like even AI probably, like come into many other industries, you won't be able to do that.
What were the things maybe before Lido that, the rabbit holes you went down on that were, like got you most excited or obsessed?
Yeah, in the beginning, I was very focused on Bitcoin. I thought this was the main thing to understand first, which sent me down, the rabbit hole of, well, what is money? How does it work? What is banking? I could tell that there was some truth to, I think, what Bitcoiners were saying about maybe money and the banking system, but also there was like so much stuff that they were saying that was like simply wrong, right? Like I think all of the ideas that Bitcoin people have about fractional reserve banking and like all of that stuff and fiat money in a lot of ways is just like completely not true. But they were still kind of interesting. Like they were right about some parts. I mean, the relationship between like government and money, I think is like one good example, or the way that money can be weaponized and, or like used to control people and societies. And so I thought there is, an interesting connection here, but I think I quickly ended up thinking that Bitcoin competes much more with gold than with the dollar. Yet at the same time, there's like a hierarchy of money in on which like both gold and the dollar also exist, right? And so it was kind of, for me, that was a very like formative, I think, couple years, like just like building up all of these mental models to make sense. And Bitcoin for me was very interesting. Like I could see the value for sure. And once I had that part kind of locked down, it was more about like, okay, how does it actually work? How does it evolve? Like, how does it evolve? How is it governed? What are like the social systems kind of on top of maybe the technical system that is Bitcoin? What if we have, we have this model of like how Bitcoin works, but what if we play it out 10 years into the future, 20 years into the future? How does it change? And like for me, for example, the idea of Bitcoin security model and the block subsidy that is going to run out, that was like a very clear, like that wasn't even a long tail risk. That was just a fat tail risk, right? That for some reason was like illegal to talk about.
Yeah. That's still something that worries you a lot when it comes to Bitcoin.
I think it does. I mean, it now worries me a bit less than it has. I mean, fees are still very low on Bitcoin, but I think now that Bitcoin is starting to have a bit of a layer 2 roadmap, and we are starting to see some reasons why people need to use the layer 1, maybe for DA, maybe for settlement between different layer 2s. I think it is at least easier to envision that that transaction fees at some point, like there is enough kind of an economy on top of Bitcoin that you don't have to worry maybe so much about that.
Yeah. It still worries me as well. I do think it's a big kind of thing that people in Bitcoin just. I think it's also the sort of stuff where people talk about the risk for a while, worry about it, but then they're like, is there anything actionable you can do? I'm like, really hard, right, to do anything. And then you just sort of forget about it. And then you ignore it, right? Because it's like, well, the risk was discussed, it didn't go anywhere. So then, like, no point to sort of, like, people are not interested in revisiting that discussion. So I feel like now it's really, I feel the only time when this will become a big topic is when there's actually real security issues.
Yeah. I actually thought the other day, I was asking myself if I've become like more jaded and like more, I don't know, less kind of willing to like push for big things in crypto. Because when I was new to crypto, I was very much like, oh yeah, the security budget in Bitcoin, that's clearly a problem. Let me write, like, let me tweet about that, like, and write articles about it and go on podcasts and discuss it with everybody, like seek out people to discuss it with, try to lobby for, not even for changing something in the beginning, but like for getting people to agree that it's a problem, so we can have a discussion about how to address that. And I was, that was uh, like an uncomfortable time, right? But also like a time of basically like extreme growth. And now I mean, there are still, of course, like things that I would change in crypto, but I was wondering if I kind of still have that, same maybe energy and like this confrontational energy as well, right? To kind of go out and like just single-handedly push for like something to change. And yeah, it was a kind of interesting maybe look in the mirror. So, maybe it's time to go back more towards that.
Yeah, but of course, it's so hard to make changes, right, when it comes to some of these things. How did you get involved in Lido?
Yeah, I mean, from Bitcoin had this very simple scripting language. You couldn't, I mean, I'm not very technical, but it was clear to see that you can't do very much with it, right? Like when you're in Bitcoin, you don't have much maybe of an appreciation for what Ethereum is trying to do in the beginning. But for me, the time when I started to really pay attention was maybe about like 2019, when some of the first DeFi apps started to launch. And for me, that was a sign that, wow, this is really interesting, because this isn't just a kind of fork of Bitcoin that's maybe doing like some things differently. This is really adding a new dimension to what crypto can do, right? The idea that you can build smart contract platforms, you can have these decentralized smart contracts, and this is, in some ways, it's like a superset of Bitcoin, right? Because like you can, like, any token can exist. Like a token is just a smart contract, right? It's just like a smart contract account where people have like, balances, like signatures and balances, right? And so yeah, that for me, that was really eye-opening, kind of to see those DeFi apps. And at this point, I think I gradually started to spend like more and more of my time looking at Ethereum and looking at DeFi in particular, because of all that prior research and like education that I'd already done on like how finance works and money and those things. I think for me, DeFi clicked much earlier than for other people because of that then, because I had done that education in Bitcoin. And I mean, you still have like, just I logged on Twitter yesterday, and there was like a thread from like a top tier VC who was like talking about how we can bring like algo stables back, and like whether this or that hasn't been tried. And it's like this just like extreme misunderstanding of like how banking works and like how money works. And I'm like, yeah, like, sometimes it's hard to appreciate like, what you know, or like how that's not, you shouldn't take that for granted in that sense, right? And so there's like a lot of people even in like Ethereum who don't know even like the first thing about finance and so on. And like I think we are still like early in kind of understanding DeFi and appreciating that. And yeah, so like more and more DeFi happened on Ethereum. And then I think at this time I was, you had Georgios on the show probably a couple times as well. Like we were very close back then. Joseph was still living in Europe at the time, and we were working very closely together, writing like a lot of research articles and doing kind of just like explorative stuff in the Ethereum ecosystem. We were very, when this was before EIP 1559 happened, and we were very focused on topics around MEV and, transaction fee mechanisms, which also like grew out of my interest toward transaction fee mechanisms in Bitcoin, and how if we maybe change that, we can change the way that like how much fee revenue can be raised from people transacting, right? And so it was very natural for me then to ask those questions in Ethereum, and I gravitated a lot towards this EIP 1559 proposal, which Vitalik had made, I think, already like 2 years before. And it didn't, he never really pushed for it. It didn't really catch on. And so it kind of lay dormant. And then there was a kind of push to revive it and bring it back. And we were doing, I think, some data, like simulation-based analysis about that and writing articles about it. And one of the topics that we were interested in was basically staking pools, because Ethereum at the time was about to switch to proof of stake, or like proof of stake had been in the works for many years. But that was one of the things we wrote about. We wrote an article about kind of staking pools and like the difference between centralized and decentralized staking pools and staking derivatives. And we basically concluded that in Ethereum, there was like a really good setup to create a decentralized staking pool and like for this staking pool also to have advantages over centralized staking. That would kind of give them a leg up in adoption. And between those staking pools, you had a real, or at least we thought you had a real kind of winner take most dynamic, because you could introduce a staking derivative that could itself become a building block for like other things and like be used in other in other DeFi apps and so on. Because, like even like tokens themselves are just like, have liquidity effects and network effects and so on. We thought that basically because staking derivatives are going to be winner take most, that means that staking pools would also be winner take most. And that article was very influential at the time. And Paradigm was already an investor in Lido, and I connected with the Lido team over that article, and we got to talking for a couple of months, and maybe like a half a year later, I became an official advisor to the team.
Yeah, we were also correspondent. I think we started talking about like liquid staking idea in 2018, right? Like right when we started it. It's just such an obvious idea, right? And then I think we did built the first like liquid staking thing for Cosmos in like a hackathon in 2019, I guess.
Yeah.
Also a long time ago now. And then we wrote this big kind of paper on, the risks and how to do it. And although it was a little bit focused on Cosmos. Actually, I remember we were also thinking about Ethereum a bit at the time. But we were like, withdrawal thing, like how can you do it? Like, that was one thing. Of course, then having the kind of multi-sig initially, or if the threshold signature was like, and then the other thing was like, but the LDO, it's just like looks a lot like a security in some ways. But I think in the end, I think the choice is right. But then of course we were very involved in Lido as well, right? And like launching it from the very beginning. But I think in the end, it's also something where we kind of saw a lot of people were much more conservative back then in terms of regulatory risks, right? And I think we've kind of seen that, just the winning path has also been just to, go ahead and do it, right? And you do it in an ethical way and try to have decentralization and be honest and stuff like that.
The right level of risk in business is almost never no risk, right? There's almost like a form of controlled risk that you want to take. And I think what matters at the end of the day is that, you do stuff that like lets you still look in the mirror at the end of the day.
Yeah,
right?
absolutely.
There's like so many things you can do that are risky, but that are also unethical. And there's like things you can do that, maybe are risky, but not, in a way that you hope is going to become less risky over time, and also that you have no problem justifying to yourself, because there's no other people getting hurt from that, right? Like, it's like net good for the world, I think. So yeah, I think that's definitely one of those examples.
Yeah. So of course, in the beginning, right, Lido, yeah. So there was basically kind of like a multi-sig in a way that was later removed, right, when they started having withdrawals to smart contract controlled.
Yeah, the problem was that, like, you had the separation between the the beacon chain and the kind of the regular Ethereum chain, right? And so the beacon chain, you were not able to own a beacon chain validator with a smart contract yet, because the beacon chain did not, I think, like support smart contracts. Like, the technology didn't exist. Like, only EOAs could own could control these like beacon chain validators. And so the best you could actually do here was a kind of like MPC secured like multisig, right? You couldn't do a smart contract. Like, that was added only later.
Yeah. And then, so in the beginning, right, so it was basically that. And then you had 5 validators, was the initial set. And, people could just deposit their ETH, get staked ETH. And, it had a huge amount of traction. I think probably I mean, my view is there was like 2 big reasons for it. Maybe it was a third little bit of a reason, but I think the biggest reason was the withdrawals, right? So where you basically you had to stake your ETH, and then you wouldn't be able to unstake it until actual the merge happened, which you didn't know how long it was going to take. Could be 3 months, 6 months, a year, who knows, right? So of course, huge amount of uncertainty. And then no native delegation, right? So Ethereum, I think, I mean, my view, Ethereum is a kind of an example where the system of staking design was a bit of a failure in some way, from the perspective that like it was designed around the idea that people will run their own validators at home and no in protocol delegation. And I was just completely ignoring what people actually want. And then Lido kind of built the thing that people actually want, which is just a simple thing where you can just stake any amount. So then I think Lido really, right, we saw also even today, right, liquid staking on Ethereum, there's like way more adoption than on any other chain. I think for these reasons.
Like, I mean, I've seen so many different liquid staking protocols launched. I mean, every chain has like 3 to 5 different liquid staking protocols. Like, even chains that have yet to launch, right? Like, there's like 3 different liquid staking protocols on Monad, and there's like 2 on Mega ETH and whatever, right? Like, every chain has them. And I'm not bullish on any of them, because you need like a very specific set of circumstances to be true for liquid staking to repeat the kind of success story that it has on Ethereum. And one big one was basically the fact that, like, if you staked, staking was like a one-way door, right? Like, the merge ended up taking how long did it end up taking? 2 years, right? Like, I think it was like locked up for 2 years.
Yeah, I think so.
Or maybe it was 18 months, right? But like, I think the like most optimistic estimates were like around 12 to 15 months, right? So, and like the conservative ones was, okay, maybe it's like 2-3 years or even never, right? So like, you were taking a risk. And I mean, the risk was less of the problem, which is like the discomfort from basically locking up your money for a long time. And so the 2 solutions to that were exchange staking. If they offered you a derivative, then at least you could sell the staked position inside the exchange, right? So maybe they could also issue like the derivative on chain, and you can also trade it, etc. But like, exchange staking, like, we were very anti that, because we didn't want like exchanges to play. Like, exchanges are already the most valuable players in the crypto ecosystem at the time, and we thought if they also control the chain itself, like, wow, that's really bad, right? And so and the other was staking in multiples of 32 ETH, by like, maybe ETH was like 1 to 2K or whatever at the time. Maybe it was even higher, but like it was like 50K plus to stake, and you couldn't stake in like lower increments. That was very bad also, right? And so, I mean, those two things were basically, those were like the golden ticket, right? In a sense, like why a liquid staking pool would do so well on Ethereum, but like all liquid staking ratios are super low on like virtually every other chain other than ETH. Like even Solana, it has like 1% or 2% like liquid staking penetration.
I think it's a bit higher now, but
yeah, it might have increased like since I last checked. Yeah, but it's very small. Like it's not really comparable. I think that was like a good. I mean, both are necessary because like otherwise everything would be captured by exchanges, and like and like a good environment for Lido to launch into, I would say. Yeah.
yeah, absolutely. So when you think of Lido and the history of Lido, what are the main evolutions in the protocol, the main changes that have been enacted since the launch?
Yeah, I mean, the launch itself is interesting. I would, in some sense, I would call it like the pragmatic age, right? Like the V1 is like all about pragmatism because, as you were saying, like, yes, like there was a small number of node operators and the tokens were controlled by a multisig. And like it was all basically for technical reasons, right? Like you couldn't actually control like beacon chain validators with a smart contract yet. And like the baseline also at the time, it was people staking on exchanges, like because people didn't want to lock up their funds for 2+ years, right? They wanted some liquidity, at least like all of the big capital did, right? And so it was like, is this better? Is this better? A, is this better than like staking on an exchange? And B, does it have a path to decentralization, right? Like those were the two questions that Lido was asking itself, and like it made all of the right choices, or that were like very pragmatic choices as well. That kind of you needed to balance, growth and like health for Ethereum because you didn't want the funds to end up on an exchange, and like path to decentralization, I would say. So then when I think 2 years later, like the merge happened, and this allowed, Lido then also to add withdrawals to the protocol. I think took maybe like a couple more months for that then to happen. And I would say Lido has always been on kind of two tracks. One is basically serving users and like making the best possible product, and the other is about decentralization. And it was always about balancing these two things. And so the first track, I think, in a lot of ways is about simplicity. Like just like click one button and like have me, stake my ETH for you, and like give you the most rewards, right? And the other is, I think, also like integrations, liquidity. So you can actually, with a token that you get in return, you can actually go and use it, right? Like you can borrow against it in lending markets. I think that really was the biggest thing, like unlocking, making like staked ETH on the beacon chain, turning that into like a collateral asset, like unlocking the collateral value of that, just made it so much more valuable. And this would later, I think this like track, like of just like making the best possible product for as many users as possible, that will then, I think, motivate like V3 as well, as we're going to talk about in a minute. The other track was always about decentralization. So having like a really good node operator set, so having like always like growing the number of node operators that stake is distributed across, making sure it's geo distributed, it's client distributed. All of the node operators are following like best practices around how to run their staking setups, and like make sure that nobody's ever getting slashed. So it was a big deal. And then the other two are kind of making withdrawals permissionless. So the idea that if you actually hold any staked ETH, you can always go to the protocol and you can redeem it for ETH, and nobody can stop you, right? That is a big kind of North Star goal. And one step towards that is like going to be triggerable withdrawals. So that's, I think that was added in the last hard fork, I think, in Ethereum. And the other one is dual governance, right? So the idea, so first of all, you need a way for like someone to programmatically trigger withdrawals. from the beacon chain, in the sense that like the node operator with the funds are delegated to, it's just getting ejected, so they have no way to like stall it out or something. So that was important. And the other was for people to be able to withdraw without governance having any way to stop that. And so that is the idea of dual governance. And so dual governance is an upcoming upgrade to Lido, where where basically staked ETH holders have a way to escalate and like freeze the governance system when they think like a contentious proposal is happening, and that gives enough time for everybody to withdraw. And so it's what this really gives you as a staker is you can always withdraw, like that nothing can happen in governance really, like as long as you assume that like a small number of parties is paying attention to act in time, and then the protocol can be frozen and like everybody can withdraw their money. And so that would then basically make withdrawals entirely permissionless, which is a huge deal.
Yeah, because probably not all listeners remember this or followed this back then, but for a while Lido was very controversial. So I think there was different reasons for it, right? One was that Lido ended up getting very big, getting up to about a third of all the ETH stake was in Lido. And so, of course, people are like, oh, if there's more than 1/3, then... And then I think the other big concern right here was that you had the LDO token, which is the governance token of the Lido protocol. And so you, of course, had like, oh, well, if now we have all this ETH that's kind of, controlled by the LDO token, and then, maybe the LDO token, or they could like do something to, I don't know, control the protocol, extract value. So, of course, that was never really, it's never a risk, I would say, in the sense that it wasn't the Lido philosophy or values or goals. And I think Lido is very conscious, right, of these concerns, right? So I think then the dual governance kind of...
Yeah, I mean, I wouldn't say that it wasn't a risk. Like, I think the risk never materialized. Like, it's not. So I mean,
it's not zero risk. Yeah,
these two things are related, right? Like, I mean, like the fact that Lido controlled 1/3 of ETH. I mean, what does control mean, right? That's the big question. And so the reality was that LDO could really exert some amount of control, like over the stake, right? Like it couldn't really control like the hundreds of node operators that the stake is distributed to, but it could, with some reason, like it could, for example, prevent people from withdrawing at the time. Like if that's a proposal that like you want to make and that passes like the vote on chain. And so it's really like the question is, how do you fix those holes, right? And like a very big part is like kind of neutering the ability for LDO to make any decisions that would actually be bad for users and bad for Ethereum. And so I think then, there's that like attack vector becomes closed. That said, like even people like on the Lido side, or I mean, there were many people, this was a thing that the community was very divided about, right? Like, because even like many people who weren't working on Lido were in favor of like not self-limiting the growth. And the reason was that the other, the alternative, like self-capping, was also seen as risky. Like it had its own risks, right? And that was the idea that if the market really is, like if the market for staking derivatives really is winner take all or winner take most, then if like the good guys basically like self-cap and like the bad guys don't, then you just end up losing the entire market, right? And so that was, I think, a big kind of rationale at the time, and I think we're like fortunate that it didn't play out this way. But I don't think it was a given, right? I think we ended up seeing that like the demand side of the market ended up fragmenting more than we thought, and then that led to like basically like a fragmentation on the supply side as well, which we can get into.
I don't know. Do you want to talk about institutional staking or Lido V3? Maybe we go to Lido V3 first.
Yeah, we go to V3 first. There's one more thing on like I have on decentralization, which is the other big North Star. There's like, having a good node operator set, having permissionless withdrawals, and the third and like final one is having permissionless node operation. So not just the ability for people, like for stakers to join and leave like permissionlessly, but also for node operators to do the same thing. And that is basically like happening also in major ways. There's the community staking module that made staking permissionless, and it's like slowly being scaled up. There's also like DVT, distributed value technology module, which is the idea that you have if you have let's say like you have like a multi-sig of 5 and you have like 3 node operators in that set who are either curated, i.e. like secured by reputation, or like CSM validators, i.e. secured by a bond, then you can just add 2 more, right? And they can't control the validator, right? Like they can, it's like another way to like make it so that people can join permissionlessly, maybe with like an even lower bond or secured by like a smaller amount of reputation. But yeah, so just the idea that like you can make the protocol more permissionless over time, and also the way that like stake is routed across these modules becomes basically like more and more automated over time. But yeah, so I was saying before, one staking derivative didn't end up winning, didn't end up growing, to like the majority of the market, and that was because it turned out that there were, at the time staking was seen as like, well, one staking setup is like the same as every other staking setup, so then liquidity became a real differentiator, and integrations and that kind of stuff. But as it turned out, you basically saw 2 big trends. And one was the rise of restaking. So the idea that like people were staking, like they wanted to like stake the ETH on the beacon chain, but also then kind of stake that validator again in some setup where they were maybe earning extra rewards. And Lido did not participate in that. It was like seen as not in the values of the protocol to do that, to kind of take, to rehypothecate people's stake. And, it basically gave rise to new protocols that did that ended up like taking more risk, but also paying more rewards. And I mean, mostly, or like not mostly, but like it was entirely fueled by kind of inorganic growth incentives. Right? We're talking about liquidity mining in the beginning, right? This is like all liquidity mining, in the sense that there's nobody actually using that stake and is actually paying any like organic rewards. And there's also no slashing or anything. So, it's just purely like building the supply side, paying people points, and ultimately like eigenlayer tokens, for example. And, that ended up soaking up a lot of ETH. And this was like a big use case that Lido didn't serve. And the other was like more institutional forms of staking. So I think as like more and more like institutional players started to come into crypto, what you ended up seeing was they had different, oftentimes, either like risk management, like more internal based, or like more regulatory, i.e. like external based kind of constraints and desires about what they wanted to do. So for example, if you have a constraint, like you need to know the node operator you're delegating to, and you actually need to have like a pen on paper, like actual legal contract with them, then that was a thing that like Lido did not serve you at the time, right?
Aside from, of course, running, Lido validators, and we started using it, and it's also a while ago now, but I think there was one very elegant design was the stake-wise design. And the stake-wise design basically allowed you to have different vaults. So, we could have we could have a public vault that people stake with, or we could have a vault just for a particular customer where like no other assets would be. And then of course you can have whatever fee agreement you wanted. You could decide different, maybe DVT for one or not. Like you could have one validator or different sets. It was extremely flexible. But then the thing that stake-wise also allowed you to do was that all of these different vaults, and there was no fee from the protocol on any of these vaults, but it would allow people to then still mint a liquid staking token, OSETH, that was shared across all the vaults. And then, for example, EigenLayer added OSETH, right? So then you could say, okay, I can participate in EigenLayer, right? Or I could do, we have this vault now where you can do leverage staking, right? Where you can basically take the OSETH, put it in Aave, borrow against it, and loop it. So like that, I think was a very, very elegant design that I think also inspired.
Yes, absolutely. I saw the same way that liquid staking had been around like 2-3 years at least before Lido launched. Like the idea of vaults, I think also is like is similar. I think a lot of people in the like liquid staking space or staking space in general, had been having like the same idea, or like roughly the same idea, but it wasn't the same priority or like timing. I think for everyone, I think that stake-wise, I think they definitely had a great product, and it's a very strong, I would say, inspiration for Lido V3, because if we kind of, from talking about restaking and talking about institutional demand, like the problem here was like in both cases that the staking setup that Lido gave you was not flexible enough, right? It was opinionated, right? So it was not putting your money in restaking. You were getting the same returns as everybody else. You were not able to choose who your node operator is and like what maybe V relays they use and if they use DVT or not, right? So it was all like one big pool. And so I think the idea of vaults then to kind of put that like on top of what Lido already has is a very kind of organic one in the sense that when you have that, you've already explained it perfectly, right? Like a vault is just, it's the idea to like create your own staking setup with your own node operators, and then have the ability to mint the liquid staking token, like in our case, stake ETH, against that with a collateral ratio that is based on that vault's risk profile. And I mean, I would say that there's a big difference still between like vaults in Lido and vaults in Stakewise. And it's just like staked ETH is like just like 1,000 times or whatever, like more liquid, right? Like that is like a big difference, right? And so the ability to be able to mint the most liquid and most integrated staking derivative, that does make it like a much better product.
Yeah, absolutely. Of course, I think where stake ETH is absolutely no doubt by far number one, right, is in terms of liquidity for stake ETH and integrations in all kinds of places, but I guess especially DeFi protocols. And yeah, for sure. So that is something where it's a very compelling offering. So now basically what that means is anyone, or like, can you explain to us how it works? Can now anyone go and create a vault, or is there some kind of like permissioning, or only certain parties, or how does that thing work? And then also, how does it work with the collateral ratio, right? Because in the end, right, one of the challenges is that in Lido you say like, okay, we kind of manage the risk by through all these ways, right? Through the distribution, through vetting node operators, at least for the curated set. Now, if people do their own vault, you don't really have control anymore about what they do.
Yeah, so anybody can create a vault. Like a vault is just a kind of immutable primitive. A vault has, someone who can put like the stake into it. It has a node operator that the stake is then going out to and being staked with. And you can also have a curator. So very similar to like how it works maybe on like Morpho and like, all the new like generation of lending markets. A vault can have a curator that's like setting like the parameters of the vault, and like
you can have one or multiple node operators too.
I think one. So did you ask about node operators or curators?
Node operators.
Oh, okay. Yeah. I think you can have several. I think it's like, up to you. So what a vault doesn't have by default is the ability to mint stake ETH. Right. So that is, you're basically starting with like 0% collateral ratio. Like your vault is like able to mint like 0% worth like stake ETH against the collateral that's in the vault. or maybe it's starting from some low ratio. I don't know like the exact details, but you basically need like permission from the Lido DAO in order to be able to mint the staked ETH. I think it's working the same way in Stakewise as well.
I think everyone can mint OSETH and Stakewise now, but I think by default it doesn't allow you to mint the entire amount. But I think it allows you
Well,
to
they
mint
said like
95%.
they said like a very conservative ratio, and I think that's how it would work as well, probably in Lido.
Yeah, so by default in Stakewise, I think every vault can mint, I think 95%. And then some vaults, I think it's actually just the Course 1 vault and the Genesis vault. They have some special, like, okay, it has to get to a certain size. It has to have some SWISE token collateral, has to go through governance, and then they can do 100%.
Yeah, and I mean the way that I would like encourage people to think about that is like modules in Lido. Like right now, stake is coming in, and then there's a thing that called a staking router, and it's like giving basically the right to like mint staked ETH against that ETH, two different modules, right? And like that distribution function today is permission because it's necessary for risk management. Like we have ideas for like automating that in the future. And like moving to kind of a policy-based type of governance, like governance only sets the policy, but the policy is then like implemented automatically. And this isn't technically a module, but it's like a module in the sense that like the DAO sets risk limits basically for vaults, like vaults as a whole, and then can set like what types of vaults like can get like what type of collateral ratio and like what is their minting ability. So that's very important.
So that basically will mean like someone creates a vault. I don't know, let's say Course 1 creates a vault or someone else creates a vault, and then you want to allow this vault to mint OSETH against it. You will go through the Lido governance process to get vaults whitelisted for this or approved.
I mean, in Lido DAO, we're not fans of like making these like very like low level decisions. So I think it's more likely there's like a governance vote to unlock a certain amount of like overall vault liquidity to mint staked ETH. Maybe like let's say like initially like 2%, and then 5%, and then 10%, right, of all staked ETH outstanding. And there is like a committee, like a risk management committee that is basically then charged with like allocating that capacity to different vaults. So I mean, if you if that would be your touch point then as well, like if you're Chorus One and you're launching a vault.
And what's the timeline on the Lido V3 rollout, and are there different phases to it?
So yeah, we are in a pre-launch phase right now. So I mean, right now there's like a kind of simulated way to do vaults. It's like not technically a vault, but it's like kind of like a trying to simulate that through like off-chain refunds and like giving you some ability to do custom setups. But like the actual V3, and like we're like also working with like many different parties right now, basically like getting them ready to kind of adopt it when it goes live. And like the actual V3 launch is going to be in summer 2025, so in maybe like 1 quarter.
Cool. That's very exciting. Yeah, and I guess maybe that ties in a little bit with the institutional staking side, right? I mean, I think that ties certainly the whole thing about, hey, I want to have a contract with my node operator, I want to have an SLA, like all of that stuff, of course, becomes possible then. I guess the other big thing is ETFs, or kind of sort of products that are traded in the traditional financial world, but that represent underlying staked Ethereum, where I think redemption is a big issue, right? So where basically they generally have to serve redemptions like, T+1. So if someone says, I want to get my ETH out, they have to send it the next day. But then that's a problem, right? Because the ETH on bonding period is much longer than that. So then
depending
again,
on the size of the exit queue, yeah, exactly.
Yeah.
Yeah, I mean, as you're saying, right, like So first of all, between like ETF, like non-staking ETFs and staking ETFs, the first thing to understand about ETFs in general is like they will basically all compete on price. Like ETFs is like an ETF is like a commodity, and like commodities compete on price. Like brand plays some role, but not that much. And so that's why staking ETFs are going to have a big advantage over non-staking ETFs, just because they can, like a non-staking ETF like actually needs to charge you like a fee, whereas a staking ETF, they can actually pay you right from the rewards. Like your balance is still going to grow, and they can just like charge a much more like invisible kind of fee from that. And so I think it's like it is actually a very good and like attractive product. And within the set of staking ETFs, you're basically competing on how much you can stake. Right? Like you're going to maximize like your returns by staking as much as possible, and that in turn is controlled by the size of the door, or like how many doors there are, right? And so because you need to be able to, as you were saying exactly right, like you need to be able to serve the redemption requests when they come in, and when you use like native staking, right, just like go through, just put your money directly on the Ethereum beacon chain, you basically have like one door, right? Like the door is the exit queue from the beacon chain back to the execution layer. And so that door, you don't really know how big it is. Like it's like sometimes it's can move a lot of money through, but then at other times it's clocked, and very often it will clock at the exact time when you like don't you need it to like not clock, right? Because everybody wants out at the same time for the same reasons. And so what staking derivatives give you is a second door next to the smaller like official door. There's like a back door, right? And so that's the idea of you can't just unstake your ETH to the beacon chain. You can also sell your staked ETH to willing buyers in the secondary market, and those buyers, especially if the staked ETH is trading at a discount, they have all the reason to wait to hold it on the balance sheet and then maybe redeem it like a week later or like 2 weeks later. Like that's a near risk-free arbitrage trade for them. And so you can expect that the like size of the kind of second door, the like secondary market, is going to be a really good way to kind of exit or expand the total amount of exit liquidity that these ETFs have available, and just allow them to stake more and thus charge like much lower fees. And so that's why using the exact right staking setup is that is I think that probably is going to be like deciding between winning and losing for these ETFs.
Yeah, absolutely. Anything else you want to talk about with regards to institutional staking?
I mean, we are in advanced stages of discussion, I would say, with all of the major ETF issuers. And yeah, I think it's it's going to happen like at some point. I think Lido is in a really good position because nobody else can offer like the size of the door that staked ETH can.
Yeah, absolutely. So maybe we can do a final topic a little bit and talk a bit about Ethereum more generally. I think there has been a perception of I would say a state of crisis, right? A bit in Ethereum. I mean, for one, you've had Ethereum actually perform pretty badly as an asset for a while, right? So it's out massively underperformed Bitcoin, massively underperformed Solana for a few years now. You've had the sort of crisis, so big questions around all the L2s and does value really go to Ethereum, and what makes Ethereum valuable, and what is Ethereum in the first place? Is it the world computer, or is it this kind of some sort of digital gold like money, a bit like Bitcoin, and then how should the Ethereum Foundation work? And And now you had the leadership changes at the Ethereum Foundation with new executive directors. And so actually speaking with a lot of VCs in the last months, I felt there was a really widespread bearishness on Ethereum. How do you feel about things?
Yeah, I think I tend to like not get so overhyped when things are going well, and like mostly focus always on like the negatives. And when everybody is like dunking on a thing, I try to see more of its positives. So I think I'm more, from my character, I'm more of a like flatline, in that sense, like emotionally. And I mean, I think in this particular case, it's like a positive. So I think Ethereum has never been like like that downbeat, like I think, as like people were saying. Very often I think like price performance comes first, and then people are trying to backfill like a narrative for why has it done poorly. I think there's probably some effect here like that, where like something is performing poorly, and then people are making up a narrative for why that's the case, and that narrative is very convincing to other people who then also sell it, who reinforce the narrative. When you just look purely at the fundamentals, then like yes, like Solana has caught up to Ethereum in some of the metrics that matter, but Ethereum is also leading in like many metrics that matter.
In your view, what is, I don't know, if you have like, I don't know, one or two or maybe max 3 metrics that you think are most important to look at, what are they?
Well, I think it's like number of VC-backed protocols launched, like on Solana versus like Ethereum plus layer 2s, I think would be this is a very big one. I think TVL is another big one. That one's hard to fake. Like those two would be pretty big. And then maybe DEX, something like DEX trading volume, maybe. Because I most care about like
Financial activity
use cases.
Yeah.
Yeah. The thing is, like, I think people are like looking for, I mean, I'm coming from the MEV space, of course. And so, I mean, so I know that like in Ethereum, we see actually like MEV becomes basically protocol revenue as like proposers auction off the right to order transactions in a block. We see that as like that's almost like a negative indicator for like how well the chain is doing. Like if that number is very high, it means there's a lot of MEV. It means a lot of users, like market makers and stuff, are like basically getting their money extracted from them, and it's a super bad UX, and it's gonna make people like not come back, etc. And so we have worked very hard for like many years to build an MEV supply chain where people don't get front run, they don't suffer like the worst, they don't get sandwiched, they don't pay like their max slippage tolerances. And for apps to have the tools and the knowledge, etc., to build MEV resistant applications and stuff. And then you're like in Solana, in a lot of ways, it's like totally like the Wild West, like Ethereum like 4 or 5 years ago, where like every user is getting sandwiched in like almost every trade. Everybody's paying their max slippage. And you combine that with these like coins and like use cases that are extremely speculative, right? Like meme coins, where, if I have a very short time horizon, I know I'm buying this thing to sell it like today or tomorrow. I don't care as much about my execution, right? So in this case, I'm fine paying like a 5% transaction fee, or like a 10% transaction fee, even in some cases, because it's so volatile, and my time horizon is so short. And so, and I think when you look at that, it's just like extremely, first it's bad because it's literally like money taken from users, but it's also extremely unsustainable because a chain that has this level of MEV extraction is, never going to be able to scale to like use cases beyond the ultra like short term. So I'm not saying like the problem won't get solved, because I think it will. Like we know the Jito team pretty well. Like they are aware of all of the problems, and they're like very sensible and smart. But I mean, also like the revenue numbers that like Solana stakers and like Jido are making are like, they're not good, and they're also not sustainable.
Yeah, for sure. I think that's definitely one place where Ethereum is far ahead of Solana, and where I think there's still a ton of work to do to make the whole transaction supply chain and MEV more kind of, I don't know, reasonably managed. Yeah, I agree with that. And I think the maturity of the DeFi ecosystem is also something where I think Ethereum is still far ahead.
Yeah, I mean, that's not even, I mean, I was just like, buying something on Solana the other week, and like the exchanges are on like a different level of quality, but like not in a good way. I mean, there's like, you know, I'm very used to like like using CowSwap, for example, like on Ethereum. Like, disclosure, I'm an investor, but just like I'm also like a user, and like the idea that I can have multiple solvers compete to give me the best execution, my trades are MEV protected, I can pay my gas fees and like the output token, like all of that stuff, right? Like, it just doesn't exist, right, on Solana, and it's like not a good experience. Like, I know people say they love the UX, and I think the wallets are, the like Phantom wallet is a good UX, but just like in terms of just the basic, just like getting the basics of DeFi right beyond meme coin trading, I think they still have like some ways to catch up, and framed a different way. Like, I think the maturity of the DeFi ecosystem, like all in all, Ethereum is still pretty far ahead.
Yeah, I agree with that. But to come sort of to this point about, the sentiment about Ethereum and the performance as an asset, what do you think it will take for this to turn around and for Ethereum to again be something that, grows up and creates excitement, and you feel there's momentum and people are like bullish about it and they want to buy more of it, and like, well, what does it take?
What does it take? I mean, so I think the same way that like narratives reinforce, like snowball and reinforce themselves on the downward, they do so on the upward as well. So I mean, the way that you would expect this to turn around is like people are really they're really just like fed up with Ethereum, and there's like bad news can't really face them anymore because all they expect is like bad news, right? And so it takes like very little good news to like make people slightly more positive at some point, and then like you can have a kind of snowball in the other direction. I think that's very often like how these things work. So you can try to make up like, okay, we need like fundamental changes, but very often there's like a cyclicality to these things that shouldn't be ignored. I think fundamentally, like the leadership changes at the EF, I think that was good, like hands down. I think that Ethereum has been Ethereum is research led in the sense that like it has very long roadmaps, and like things are in discussion for a very long time, and it's trying to have a very decentralized development process. It's also research led in the sense that like the core devs and like the EF researchers they are the ones driving the roadmap. And for a very long time, like industry involvement in that roadmap was seen as not desired, right? And like, you can have this at a time when you're the only chain, but when you're competing with other chain ecosystems for the same developers, at some point you need to start paying more attention to the ecosystem. And like, I mean, the DeFi people can tell you, like everybody building in DeFi can tell you like at least one very bad experience about like working with the EF, in the sense that like they're either they are like very dismissive of like the thing you're building, in the sense that like I love Vitalik, but also like his word carries a lot of weight. And so when he's like maybe writing that he doesn't like DeFi, or he thinks that like, crypto shouldn't be used for that, and he hopes that there will be other use cases, etc. Like it feels very dismissive for like the people working on that, for example, right? Or another is like when they have ideas for how the protocol should be improved, because they, it's their users, right? They know, what they get like 1 million support tickets for every year. and like they know what they suffer with, I mean, then and you try to turn that like into an EIP, even, and you're already meeting a lot of resistance in the sense that like, are you trying to like co-opt the protocol? You're trying to take over the protocol. Like, I mean, those are like very bad experiences, and I think those are things where I think you have now the full like recognition that like, hey, that hasn't been maybe so good, and like, what can we do to change that? Like, there's a new energy, I would say, and like people getting like the right people getting promoted into the right positions, like including the 2 new EDs, and like especially Tomasz from Nethermind, he has built like a very like large and successful organization in Nethermind, and they are very commercially minded, right? Like, it's amazing how they have built a very big successful company on the back of creating an Ethereum client, right? Which really you shouldn't be able to like commercialize that, right? But they have managed to. Like, they're not making money through the client, but like they have built everything around that. And to me, that's like an extremely good sign. Like, he has extremely deep roots in industry and knows all of the builders. And so I think you're seeing a new kind of energy around making Ethereum more commercially open and commercially minded. And I think that is, if there was one thing that I would change, then it would have been that for sure. And we're seeing that. So that's very positive for me.
I agree. No, I think that's probably one of the big things. Also, just a sense of like, core development moves a bit faster, more pragmatic. Tries to. I think some degree of faster scaling, I think, is an important one too.
That is the other thing, yeah. I mean, if you listen to apps, then yeah, you would have scaled the layer 1, right? Like, so there's a kind of related, but maybe it's still worth talking about separately. But I think in terms of roadmap, like, I think there must be there is now an understanding that like you shouldn't give up on the layer 1. Like, I mean, a lot of what creates this incentive for rollups to build on Ethereum is the quality of the layer 1. It's speed, it's finality. It's DA costs and transaction costs. So we need opcodes for ZK verification, like stuff like that, right? And so like there's a bit more of the understanding where, yes, we want to have a rollup centric roadmap. That means rollups are a big group of customers. So let's think about what they need holistically. And a lot of what they need, we can only give them by making the layer 1 better. And so I think you're seeing a real revitalization also of that conversation. And so I think anyone who's like buying Ethereum is also underwriting the thesis that like these two, like the people who want to push for those two things can basically break through like the resistance and like a lot of the entrenched like interests like inside these processes and like this bureaucracy that has built up, right? Because Ethereum is a very like procedural kind of community, where and like decision making in a lot of places has historically grown to be very decentralized, for better or worse. And in some areas you have like there's the understanding that like, well, this group of people maybe, or like I mean, the core developers are like the main example, right? Like you have the client teams, and like client teams decide what goes into the fork, and that's maybe that is like one of the very big assumptions that like needs to be challenged, in the sense that like often core developers do the implementing, but maybe they shouldn't be the decision makers for what actually goes into it, because like Ethereum is not the type of protocol where you can have you can be like an extremely talented engineer, but you can also still have that kind of like strategic vision and like keep the whole protocol in your head and like know what it needs, like at what time, like that at least like the set of stakeholders who get to make this decision needs to be like expanded.
Cool. I think that's a great note to end on, and I'm also excited to see sort of what this new energy will bring to Ethereum. So thanks so much for coming on, Hasu. Really enjoyed this conversation.
Thanks, Brian. It was really fun. Thank you.